Good morning, Dara Sharif here, and I'm back from the ACG Florida Capital Connection. Thought I would shoot a video with a summary of some of the thoughts that I've accrued over that period of time. I think this will be multiple videos, so just bear with me here. I just want to go over a few themes. I actually jotted down some notes because I want to make sure I get to all of them. It's not really my way, but here we go. Again, I'll probably break this into two parts, and then I'll dive in on other videos on some themes that I thought were worthy of spending some time on. So what I noticed coming out of that meetings was that I felt like I was in a time machine. So it was sort of a focus on at once old world, old economy businesses, but also tech enabled businesses, right? So sort of both, right? Into the future and into the past. But we still see a real proliferation of investment in old world, old economy businesses, manufacturing, distribution, things like that. So that's an interesting one for me. Residential services remain really hot in the market. If you think of all the services to the home, these are services that were not very attractive 5 and 6 years ago in terms of M&A from professional buyers. Now they are absolutely on fire. They continue to be on fire. I heard that from a lot of folks. A lot of creativity in terms of the structure of the ownership of the investing unit. So obviously traditional private equity, family offices, we see independent sponsors, strategics, right? Those are the traditional four. Now we're seeing public and also private holding companies, and a couple of folks made a lot of money, doing deals out of their own pocket and putting together sort of a small portfolio, like a junior varsity version of a PE fund, which I thought was interesting. And then one more, which was really, I think, relatively new, is sort of that post-fund approach. So a successful fund, 5, 6 funds, decides that, hey, let's not deal with the burdens of having an actual fund. Let's just deploy almost in an independent sponsor model, right? So they have access, they have all these LPs who want to write a check. They can strategically go to those LPs on a deal by deal basis and not feel compelled to deploy when they don't have a deal ready to go. I thought that was pretty interesting. Still seeing continuation vehicles out there, maybe a bit less so than I heard last year. And I think I'm going to dive into that one as a separate video at some point, because continuation vehicles are pretty interesting. They do create some potential conflicts of interest between the LP and the GP. Actually, the LPs, there's potentially 2 different LP bases, and that creates potentially a conflict. I want to talk about that at some point. Virtually every fund told me the first half was incredibly slow for them, and it picked up in the second half, which is good. And a lot of them are saying that they believe, based upon their metrics, how many NDAs they have in queue, SIMs that they expect, that the first quarter, second quarter should be very strong. We believe the same thing here at Benchmark as well, although most have said that they're out of the predictions game. It's probably a good plan given some of the uncertainty in the market, where things can change with the stroke of a pen. So I'm going to leave it at that for the first video, and I'll do a second video with the second half of my thoughts and lessons that I've learned and themes that emerged coming out of the ACG Florida Capital Connection. Thank you.